The United Kingdom has been going through a debt crisis that has escalated due to rising fuel prices due to the sanctions on Russia. The first national debt was created in 1692 when the government borrowed money to fund a war against France. In the years following, the UK government borrowed money to finance other wars, as well as to build roads, canals, and railways. In the 20th century, the UK government began to borrow money more extensively. This was partly due to the First World War, during which the UK government borrowed money to fund the war effort. After the war, the UK government continued to borrow money to rebuild the country. The UK government also began to borrow money to fund social welfare programs. In the 1970s, the UK government began to borrow money to fund the national healthcare system and the national pension system. The UK government's debt increased rapidly in the early 21st century. This was primarily due to the global financial crisis of 2007 to 2008. The UK government had to borrow money to bail out banks. The UK government's debt continued to increase in the following years. The government introduced austerity measures, which included spending cuts and tax increases. The UK government's debt reached a peak in 2016, when it owed a total of £1.6 trillion. This was equivalent to 86% of the country's GDP. The government has been trying to reduce the country's debt since 2016. In 2017, the government introduced a plan to reduce the UK's debt to GDP ratio to 75% by 2023 to 2024, which is currently at 85.4% of its GDP in 2022. The UK debt crisis has caused a number of problems for the country. One problem is that the country's debt is expensive to repay. In 2017, the UK government paid £51.5 billion in interest payments. This was equivalent to 3.5% of the country's GDP. Another problem is that the country's debt is preventing the government from investing in important infrastructure projects. In 2017, the government invested £43.5 billion in infrastructure projects. This was equivalent to 2.8% of the country's GDP. The UK debt crisis has also caused the country to have a high level of debt servicing costs. In 2017, the country's debt servicing costs were equivalent to 1.5% of the country's GDP. The UK debt crisis has also caused the country to have a high level of public debt. In 2017, the country's public debt was equivalent to 87% of the country's GDP. The UK debt crisis has had a negative impact on the country's economy. One negative effect is that the country's debt has caused the value of the pound to decline. In 2017, the pound was worth 17% less than it was in 2007. Another negative effect is that the country's debt has caused the country to have a high level of debt to GDP ratio. This means that the country is less able to respond to future economic downturns. The UK debt crisis has also caused the country to have a high level of public debt. This means that the country will have to raise taxes and reduce public services in the future in order to repay its debt. According to a study by Raymond Leiden, an economist at the Central Bank of Ireland, and Dr. Apostolos Facianos, lecturer in economics at Department of Economics and Finance, Brunel University, investigating whether the debt position of UK households affects the response of non-durable consumption to income and wealth changes, found out that consumption growth is significantly positively correlated with income and wealth. Consumption is negatively correlated with transitions to unemployment and picks up short-term and longer-lasting income changes. They also found that the elasticity of non-durables consumption concerning income is higher for mortgagors and renters than for households owning a dwelling, and falls in income triggered larger adjustments in household consumption than income rises, particularly for more heavily indebted households. These amplifications of income shocks via indebtedness are not unique to the financial crisis period. The findings reinforce and generalize the asymmetric shocks hypothesis, evidenced also in previous analyses for the UK and other countries. Their results have several policy implications. One is that expansionary or contractionary monetary policy or counter-cyclical fiscal policy can have larger effects in terms of stabilizing output, employment, and demand during a downturn than during an upturn. Furthermore, impact of these policies can depend on the level of household indebtedness in the economy. The results also point to a macro-financial link between high levels of indebtedness and consumer spending, which should be of interest to macro-prudential policymakers that aim to promote household resilience.